Hi, friends. So, welcome to this session again. So, we'll be looking at the first section or the first chapter, the first topic. So, and typically it's an introduction to the financial statement. What is it? Okay. I'm sure you would have heard of some accounts like profit and loss account, balance sheet. Okay. But what goes into it? Okay. Again, we'll look at the concept of financial performance or financial management. What is it innate for me? What is innate for me, right? So once again, I'm going to share my screen. Um, and I'll try to project the voice so that you can readily understand. I think yes, that's what I'll do. Hopefully, you should get it clear. All right. So financial performance management. The first one we're looking at introduction to financial statement analysis. Okay. What is financial performance management? I normally say it from two folds: financial performance, financial management. Okay. In fact, you could also think of performance management as a standalone. These are all specific subjects which are interwoven together. So you could get financial management as a big topic. Okay. You could get financial performance of a company coming to the financials, the numbers, the accounts. Okay. You could also get performance management, which cuts across both numbers and non-numbers or non-numerical items. So what we'll be looking at over here is a combination of all these three or two, depending on where you stand. So the numbers, the others without the numbers. Okay. All right. So this is what we'll be looking at. Let's look at what I said in the earlier section. What is this financial performance management? What is the overview? So we're talking of some financials, non-financials, okay. Some bit of financial accounting, some bit of management accounting, and some bit of performance management or business analysis as a strategic business leader. Okay. So we'll deal with the usual reporting, corporate reporting. It could even include some sustainability reporting. We wouldn't get there for now. We'll limit ourselves to the integrated reporting. So think of anything non-financial, okay, as well as the financial. Bring them together. So this is what we'll be looking at as I have introduced. So we'll look at this. Let's now hit the numbers. But the question is, what is in it? What is in it for me? Okay, you would read and you can research and find out that many of these large companies have accountants being the heads of their department, the CFOs, the CEOs actually. You'll be surprised that our half to 25% to half of them have some background in accounting or financial management. So big companies like Coca-Cola, Siemens, Accenture, Vodafone, Royal Bank of Scotland, Adidas, Nike, name them, have accountants leading them as CEOs, as CFOs, as COOs, name them. In UK, 55% of the CEOs of the FTSE 100 have a background in accounting. Interesting, right? And 1 in 4 are qualified accountants. Could be ICAEW, ICA, some from other country, or ACCA, even CIMA, yeah, ICAS, name them. Now, about 30% of these Fortune 500 CEOs have actually spent first 4 years of their careers developing a strong foundation in finance. Today, CEOs and these big guys even take up MBA courses or senior apprenticeship programs with big universities, okay, so that they can have some foothold in the field of accounting and finance. So there is something good there for you when you aiming to hit it hard at the very top. In this session, we're looking at the role of accounting. We're looking at a range of stakeholders, the customers, the government, the suppliers, the employees, the management body, lobby group. Okay, name them. Excuse me. Sorry. Sorry for this. It happens. Yeah. So we'll be looking at this range of stakeholders and see how best they fit into the overall game. Okay. I also introduced the main financial statement that a company prepares. and then we'll explore both the financial and non-financial information, the corporate information in a corporate organization, corporate report. What is a business? What is the purpose of a business? Why do firms exist? Once you mention the word business, everybody thinks of money coming in, right? So for economic purposes, so we exchange some kind of good or services so that we get some money in return. That's business. Normally, people think that's business. But yeah, I mean, business does not only result in bringing in money. There are some businesses which are not for profits. Okay, money could come in, but it's not typically meant for profit. So don't ever think that business is purely to make profits. No. In our situation here, actually, we'll be connecting or limiting ourselves to the economic aspect, so the profit-making businesses, not the not-for-profits. Okay, so like the charities, we're not going to deal with that one. The NGOs, the IGOs, no. We'll be dealing more with the profit-making entities. Okay, so for us here, we're looking at every business requires some kind of investment. We need enough customers so that when we sell our goods, we make a profit. That's what we'll be looking at. Okay. So primarily, what's the purpose of a business? We're looking at enhancing the wealth of its owners. How do they do that? I invest £100 today. I don't expect that in 1 year, 2 years, my £100 still remains where it is. I expect it to at least give me some £1 extra. Okay. So the wealth increases. The share prices will increase. Okay. I have to see this wealth maximization manifesting itself in dividends, the interest that the shareholders receive. Okay. So that's the purpose of business in our context here. Okay. So we want to maximize sales, we want to maximize profit, we want to achieve a particular target market share. And then in the long run, our wealth as shareholders, or the shareholders' wealth we as a company we are managing, would increase. So we want to survive as a going concern. But again, it's not only about maximizing shareholder wealth. We have other things. Okay. Make sure you don't destroy the ecosystem in which you operate. So sustainability comes in there. Conserve the community. Provide the employees with good and conducive working environment so that they come in happy and they work with passion to improve your profits. Okay. Products should be safe, should be of the highest quality, affordable to customers. That's also one reason why businesses exist. Okay. And also, you deal with suppliers. They sell to you on credits. Make sure that any trading, supply chain activities you undertake with your suppliers are fair. So follow fair business practices, trading practices. Don't be working with a supplier who engages child labor for their work. Don't look at that. Okay. Now, I would want you to do this on your own. So some of the things I want you to research. Why do firms exist? There is Ronald Coas's theory of firm. I want you to look at it. It's the Nobel Prize winner in economics in 1991. So ask yourself, why do you can conjecture, but I want you to research on this theory of firm and you will understand what it is. Okay. There are some rationale. I'm just giving you some hints of what goes into what you'll be researching. Economic rationale, like I said, to make profits, to make money, to maximize shareholder wealth. Okay. Now, who should benefit? Is it only the shareholders? No. Everyone must benefit. So shareholders gain some foothold, yes, but customers, employees, management, the government, the local community, the suppliers, they should all get something from the business surviving, operating in their system. Okay. So you get this theory, legitimacy theory. The economy gives that legitimate power to the company to survive in the system. So the question is, what do they also give back to the community, right? So shareholder value, what is value? We normally want to limit value to monetary, cash, the numbers, the currency. So there's a stakeholder theory where Friedman, he said the social responsibility of a business is to increase its profits, said this in 1962. So he emphasized the stakeholder theory. Well, it is actually split into two. We have the normative and then the managerial. The managerial and then the normative. Yeah, they split into two. We're not going to those theory now, but what I'm saying is that The shareholder theory, the stakeholder theory is split into two. Okay, the managerial aspect and the bigger picture. Okay, I'll explain that in the next bit. But the shareholder theory, which Friedman emphasized, looks at only profit numbers, the figures. So all he's saying is that, listen, operate to the benefit of the owner, the shareholder, the investor. So give them some good dividends, share prices should increase, we should make more profit. That's all. Then we've got the stakeholder theory against the shareholder. Stakeholder theory is saying you can't just satisfy everyone. You can't just satisfy one person, you must satisfy everyone. Okay, so shareholder theory focused more on shareholders. Stakeholder theory says no, there's not only one person who should benefit, everyone should benefit. Okay, so Friedman more with shareholder theory, Freeman with stakeholder theory. Now, like I said, the stakeholder theory is split into two. One school of thought is saying that satisfy only the key stakeholders, those you can see around, the shareholders, the customers, the employees, those ones you can, the suppliers. And then there is the bigger picture which says no. The water body you destroy today goes a long way to affect somebody in maybe an underdeveloped country who will not get a good potable water to drink. So you must ensure that you safeguard the ecosystem. In fact, it goes a long way to say that you must even put in measures to secure the future of someone who is yet to be born in 100 years' time. So there are two schools of thought. Says key stakeholders, satisfy them. The other one says the bigger, everyone. But of course, you can't satisfy everyone. Okay. So for stakeholder theory, it emphasizes responsibility over profitability. Don't look at only numbers. So look at the bigger picture. Those who need to benefit must be benefited. Okay. Expand your beneficiary pool. Okay. So like I said, look at these stakeholders. Customers, they want affordable, quality products, good customer service. That's what they need. That's what they consider value. Lenders, those who give you money, the banks, they want you to pay them interest on their loans that they've given to you. You pay it on time. That's what they consider value. The managers want to get a job security just like employees, okay? But they want to also make profits. And then once they make profit, based on that, they get some good bonus. That's what they consider as value. What about the regulators? They want you to comply with laws and regulations. Don't destroy the system in the quest of trying to satisfy or gain profit. That's what they consider as value. Suppliers, I supply goods to you on credit. Pay me on time. Pay me on time. I need my money. Okay, that's what they're also interested in. The employees, we need a good, conducive working environment. We want job security, job satisfaction. What about the owners? They want dividends. So you could see that all of these guys have an interest in the company. So there will be conflicts. The community wants you to give them the potable drinking water. Don't destroy the ecosystem. How do you do it? Money from the profits. Employees want you to give them increased salary. How do you get it? Where do you get it? Money from the profits. Owners want dividends because they've invested, they need some returns on their investment. Where do you get it from? Money from the profits. Regulators want you to comply. So compliance comes at a cost. How do you do it? It comes from money, from the profits. Lenders, suppliers, they want you to pay them on time. How do you do it? Where do you get it from? Money, from the sales, from the profits. Customers want you to give them affordable products, quality products. So where do you get it? You must get money, invest in research and development, give them quality products. And also, so where do you get money for the research and development? Profits, sales, money. And give them affordable products. So if everyone is selling it at £10, give it to them at 8.5. What does it do? It reduces your money. So someone is pulling. Someone is pulling. Like a tug of war. You have to manage this in a critical way. Freeman says, saying that profits are the only important thing to a company is like saying red blood cells are life. And you ignore the white blood cells. You need more red blood cells to have life, but you need so much more. He also says if you can get all your stakeholders to swim or row in the same direction, you've got company with momentum and real power. It hardly happens. It hardly happens for them to all swim towards one direction. Look at stakeholders in a business. So these are publications from some outlets. So BBC mentioned Volkswagen, the scandal. You may have heard of the VW scandal with emissions. The Guardian, Tesco to pay £129 million fine over accounting scandals. How Nike solved its sweatshop problem. Cambodian female workers in Nike, Essex, and Puma factories suffer mass faintings. Why? So much work. Let's pay. So everyone is interested in watching us as a company. What do you do? There's something else we want to move on to: the mission, the vision, the values. Values are like the should I say the factors that drive us to success. Integrity, honesty, respect, working together as a team. The vision is the long-term strategy we look at, long-term horizon. Mission deals with typically what drives us on day-to-day basis. So take Novartis, their mission. Of course, these are just schools from some companies, Earthlink, Sigma, and Novartis. This mission says we want to discover, develop, and successfully market innovative products to prevent and cure diseases, to ease suffering, and to enhance the quality of life. We also want to provide a shareholder return that reflects outstanding performance and to adequately reward those who invest ideas and work in the company. It runs day to day. It keeps us going operationally. Tactical way of ensuring that we provide value to who? Our shareholders, our stakeholders, as a bigger picture, okay? Not only shareholders, our stakeholders on the bigger picture. Vision long term. So to be a top quartile specialist within 5 years. So it's looking at the bigger picture. And then value to respect. So you could see respect there as a value, which drives them. So it's an attribute. It's something which makes the company unique somehow. Okay. Every organization has values. So respect the individual. That's respect you see there. We believe that individuals are treated with respect. So same respect there. And giving responsibility to respond by giving their best. So responsibility is there. I work with KPMG, and I remember we had about 7 values. One of them is, above all, we act with integrity. We seek the knowledge and share the insights. That's also one of the values. We work with the community. We respect the individual. So a lot of values come in. You need these values to drive you. Okay, so this is a company with values. So we could see their values: integrity, commitment, customer focus, results, teamwork. Okay, they've got a mission to be a solid and reputable medical imaging company, considered by the stakeholders as the best partner of choice. And their vision is to provide innovative clinical solutions from prevention to therapeutic solutions or applications. All right, this is what I want you to do. Read the annual integrated report provided by Jessina on the site, okay? Or you can generate it. You can go online, go to annualreports.com and generate Jessina's annual report. And then ask yourself these questions. You'll find it clearly. You can use Control F and then Control F here. And then you'll find the mission. Just type in mission. It will pop up. The vision, the values. Who are their main stakeholders? Main stakeholders, okay? So stakeholder theory, we're talking of the ones we can manage, the managerial perspectives. What is the balance of financial information versus non-financial information? In fact, gone were the days that you take an annual report and you see numbers only. Today, the reality is that the narratives, the non-financial component, far exceeds that of the financial component. So this is what I want you to do ahead of time. What is accounting? Accounting is not mathematics. People think, oh, if you're an accountant, for example, some people see me, they say, I've done a PhD in accounting and finance. They say, oh, this guy is good with maths. Oh, no, not at all. Accounting is not mathematics, okay? It's not mathematics. Accounting is simply like a research that you do with numbers. With research on numbers, you collect the data, the relevant data that you need. You put them together, you analyze them, and you interpret them. So in accounting, we communicate the reality behind the numbers. That's all. We do some analysis. So you will see the American Accounting Association defining accounting as a process. It's a research process, somebody will say. It's a science. It's both a humanities and a science discipline. Let me put it that way. We identify the information, we measure it, and we communicate economic information to permit these stakeholders to make informed decisions. That's it. So when you dealing with accounting, we communicate reality. So by presenting the numbers, the financials, you will never see a financial report standing alone with the numbers and we expect you to interpret it. No. You get them and there's a footnote. So accounting, you will see the components of the financial report. You get the income statement or statement of profit or loss. You get the balance sheet or the statement of financial position. You get a cash flow statement or statement of cash flows, however you want to mention it. And then sometimes you get a statement of changes in equity. Okay. But there's a key other statement which we hardly mention. That is the notes to the account. They are statements. The notes to the account, the footnotes, the additional information which explains the numbers. So who are these users of the financial information? Like I mentioned, the stakeholders. So managers, investors, lenders, suppliers, employees, governments, customers, public. These are the users of the financial information. Accounting is normally split into two. We've got the financial accounting, where we normally report to these external stakeholders. Then we've got the management accounting, where we normally use it for internal processes. Okay. Of course, financial accounting can also be used for internal planning. I mean, no two ways about that. We normally leverage on past information with financial accounting. They use historical information. Management accounting also uses historical information. Management accounting also uses historical information. Sometimes people are thinking management accounting is more forward-looking. Yes, but until you get a foundation, how do you build a future? So it also uses current and past information to project for the future. Okay, keep that in mind. So these are the differences between financial and managerial accounting. So internal parties use it in terms of managerial accounting, whereas external parties use the financial accounting bit. There's no typical regulation on managerial accounting. It's not mandatory for you to prepare it. But for financial accounting, it's typically regulated by the generally acceptable accounting principles of specific countries, the International Financial Reporting Standards. So it's mandatory. It's mandatory. So financial auditors or auditors go into audits to ensure that they comply with these regulations. Okay. Sometimes you even see that it is being regulated or required by the Companies Act of 2006 for the UK. Let me put it that way, to require that you report in line with the Companies Act. Managerial accounting reports on historical, like I mentioned, they use historical, current, and then project into the future. But for financial accounting, it's more of past information. Of course, we can use it for some planning and some projection as well. Okay. Management accounting is tailored to meet internal business needs. So the management accounting report of Tesco, for example, will be different from that of Jaguar. Totally different. Tailored to meet their needs. Okay. It is timely and future oriented. It looks at both financial and operational measures, operational performance measures, and it is normally disaggregated into informed local decisions and actions. That's managerial accounting. Financial accounting is delayed, historical. Sometimes before you even read it, it's gone by 9 months old. Some people think, well, how can I use an old information to make a decision? You can use it. It deals with financial measures only, but today, trust me, we don't only deal with financial, we interpret the financials. So highly aggregated and reports on the entire organization, whereas management accounting can deal with only the operational, only the HR, only the financial, okay, or the security or IT. Again, any information that is expressed in monetary value and can be found in the financial statements such as profitability, net income, dividend per share, dividend yield, earnings per share, name them. Research and development expenditure goes into financial statements. But any other information that is not expressed in monetary values may hardly be found in the financial statement. So the suitability of the shares or the stocks, the environmental, social, governance, ESG information, relationship with customers, we report them outside of the financial statement. So this is what we'll be doing in the final assessment. So you've got the financial statement analysis and the non-financial statement analysis, in which you look at the balance scorecard. So the 4 dimensions, remember, we'll get there, but as a heads up, Norton and Kaplan's 4-dimensional BSc, balance scorecard, which they develop. So we're looking at, again, it even has financial. So there's a financial perspective, the customer perspective, the learning and growth, and then, of course, the internal business processes. And then we'll look at integrated reporting. Okay. All right. Financial statements. They are accounting reports. We present this periodically. Financial statement could be prepared semi-annually, sometimes quarterly, but usually annually we'll find them. So it looks at summarized transactions for the year. We prepare them in line with standards, accounting standards. Okay. Auditors will review it. Okay. I mentioned the 3 main components, but they can be 5. Okay. So the statement of financial position, the statement of profit or loss, the statement of cash flows, the statement of changes in equity. At this level, we're not going deep into it, okay? Then we've got the notes to the accounts. All right. So what is the balance sheet or the statement of financial position? It's simply telling you the assets of the company, the liabilities, and the shareholders' investment or equity. That's all. So the asset is always given, and it is what forms the accounting equation. So the assets becomes equal to the aggregate of the liabilities and the shareholders' equity. We'll look at them. What are assets? So assets are split into 2. We have the current and non-current. Current means it changes within 1 year. Non-current means within 1 year it hardly changes. It lasts more than a year. Okay. Same with liabilities, split into 2. We've got the current and non-current. The current means we have to pay these liabilities, these debts, these owings within a year, or they are due to be paid within a year. The non-current liabilities are those loans, those debts, which exceeds more than a year for us to pay. So you take a loan which is 10 years old, it's not a current liability. But if you have an overdraft which you have to pay within a year, it is a current liabilities. And then we have the owner's equity, which is typically what the owner invests, the capital, plus any profits, plus anything they take out, any drawings, okay? That makes up the owner's equity. Let's see a typical example. Look at this. I've circled. I mentioned what the current asset is. They change within a year, like your cash in your bank account. Okay, your inventories, they change. The long-term assets, which are now called the non-current assets, like the plant, the property, the land, the fixtures, they don't change within a year. You add and you get the total assets. When it comes to the liabilities, I mentioned the current and non-current. The non-current is the long-term, okay, so the loans you pay over a long time. And then the owner's equity stands on its own. Then we've got the income statement or the statement of profit or loss. It looks at the performance of the company. Are we making profit? Are we making a loss? When the income or the revenues exceed the expenditure, we make a profit. And the other way around, we make a loss. So if the expenditures exceed the overall income, we make a loss. Easy, right? So normally you get the revenue, subtract any cost of sales or any cost of operations, anything that helped you to generate the income, subtract them. You get your gross profit. Any operating expenses like your selling and administration expenses, your salaries that you pay, the loan interest, take them off. You get your operating income. If there's any other income, add it. Maybe you got some rent received, some commission received, some interest you received, add them. Then you get your earnings before interest and tax. Okay, so you could still split it. The interest income, add it there. The interest expense is the interest we pay on loans. Sometimes you see finance costs, subtract them. Then you get the profit before tax. subtract your taxes, and you get your net income, which is then given to the owner's equity. Okay. Then we've got, so this is a typical example of the statement, income statement, or the statement of profit or loss. So there's a total sales, take out any cost of sales, you get your gross profit. Take out any operational expenses, you get the operating profit or operating income. If there's any other income, add it. You get your earnings or profit before interest and tax. You then subtract your interest expense, which is the interest you pay on your loans, okay? Then you get the profit before tax. Net of any taxes, here you get your net income, which goes to the shareholders, all right? There are some items there, earnings per share, diluted earnings per share. It's simple. Look at the way the name sounds. Earnings per share, the profit, the net income that we got, divided earnings per share, divided by the number of shares. That's all. So for each share, if you see 0.556, it means for each share, it generated these earnings of $0.556. Okay, it's not bad. It's about 50%, which is not bad. Okay. And then the statement of cash flows is just telling us that profits are not cash. So let us now generate the real cash. So go back one step. Let me show you this. When you look at this side, you see cash here, cash, right under the current assets. So cash, you realize that it was 19.5 million, increasing to 21.2 million. That's all we are going to do there. So in the statement of cash flows, you are now going to move the numbers and move the accounts and then be sure that the 19.5 to the 21.2, that difference of about almost £2, 2 million. How did it come? So the difference you get there, that almost 2 million difference here is typically telling us that, hey, we sold, we got money, we paid some money. So when we start knocking them off, the net effect was about $2 million cash. So that goes into the statement of cash flows, this one. So the statement of cash flows is telling us that let's look at the real outturn in terms of cash. Because profits are not cash. Profits can be massaged. Because the kind of accounting policy company A will use will be different from what company B will use. The kind of accounting policies that Jaguar Land Rover will use will be different from what Mercedes-Benz will use. They are all in the automobile industry, but you'll be surprised. So there are items like amortization of intangible, depreciation of tangible assets. Are they real cash? Okay, are they real cash? So you have to knock this one off. It is split into 3 sections. We've got the operating activities, so the day-to-day things we see in the income statement. Some goes into the balance sheet. And then the investing. The investing is typically limited to the properties, plant, the equipment, the fixed assets, the changes, whether we bought some or whether we sold some and got some money. And sometimes you would even see that maybe we invested in a company and they give us some dividends. It comes there. Okay, some will move it to financing. Financing is the financing. So we take a loan, we get some additional shares. And sometimes we pay dividends to shareholders. That goes into financing section. So a typical example here. So you see cash from operating activities. It can be cash inflow or net cash outflow. So when you see a bracket here, look at 2011, you see there's a positive. So there was a net cash inflow, about 200,000, 0.2 million was about 200,000 inflow, net, positive. When it comes to 2012, it was negative 1.2. So after we've done all our changes and done the analysis and moving them, actually, in our operational activities, the day-to-day running, we made an outflow, net cash outflow. We didn't get so much money. We spent so much money. So that was about 1.2 million outflow, negative, reducing our cash. You come to the investment activities, so capital expenditures, acquisitions, other investments. So again, you see that we are spending so much money going out in our investing activities. 6 million to 21 million, 15 million extra. That's it. Now, financing activities, we paid some dividends, we bought some shares, did we? We sold some shares, did we? Any borrowing, we borrowed more, then you can see that, yeah, The net effect for last year was 1.3 million negative, but for this year it is it's 4.5, that's positive, and then this year is 23.9. So more cash coming in from financing. And then we do the adjustment, the analysis, and you see that it is 1.3 negative last year, but this time 1.7. This 1.7 million, when you add it to the balance as at the beginning, so you see the cash here is 19.5. If you add the 1.7 million to it, it gives you the 21.2. That's what we do. So you normally will have to come back to reconcile the cash at the beginning and cash at the end. The difference between should be what you would have done here. What you would have done here, getting the 1.7, shows the net increase or decrease in cash and cash equivalents. It can be very technical if you want to work this out, but that's not what we are going to do. We'll not be asking you to prepare this, but it can be very technical, but it's a good one. Okay. They are interrelated. All the financial statements are interrelated, honestly. So from your balance sheet to your income statement, to your cash flow, to the changes of your equity, to the notes, they are interrelated. You pick from here, you put it here, you pick this one, you rearrange it here. They are siblings, they are Siamese twins, connected. They cannot stand alone. Then we've got non-financial information, then wrapping up soon. So we're looking at today, people are calling for sustainability. So you hear COP26, COP27, COP28. Why? We want the world to be a better place. So there's more disclosure being required. Sustainability disclosures are being increasingly required of companies. Companies want to sometimes voluntarily disclose it so that they can enhance their image. Sometimes if they don't, we compel them to. So companies may find it in their interest to disclose it voluntarily, because if they do that, sometimes it becomes part of the package to improve their credibility and enhance their image in the business sector. Now, in sectors dominated by large multinational enterprises, disclosure of such information could drive them to success, and people will love them. Research shows that voluntary disclosures enhances the image of the company, and it causes customers to come on board. Today, if you go to the shops and you buy any product, you see the labels are the red, green, amber. If it is green, it tells you that it is highly compliant with sustainability measures. If it is red, be careful. If it is amber, yeah, it's coming, it's doing well. Okay, so people are now very conscious about sustainability. Go to chapter 1 of the core text, you'll find this topic there. And if you go to chapter 2 of the Beck and DiMazo's book, Corporate Finance, you'll find it there. Good job. I'll catch you up, friends. Whilst I stop sharing this screen, I'll catch you up on the other side. So yes, please read ahead of time, and all will be well. Take care when I see you. Bye for now.